Welcome, everybody. This is our Q3 annuity stress report. This is a new format of webinars for us that we're going to be aiming to do every quarter to update our results. Now, some context. BGA, we are a, GAIMO structure that works with agents, financials, advisors, and so on for life insurance contracting, underwriting, and case design, as well as long-term care, disability, and annuities. My name is Trent Zerman. I run the annuities department here. My CHFC, CLU, been in the industry for about 10 years and recently completed my graduate certificate for estate planning and finance. So I took over this role about 2 months ago, and there were two main goals: expand the scope and expand the reach. Reach being working with more agents. And so you probably noticed more emails and phone calls coming from me. And expanding the scope, the amount of annuities we have to offer. So now we're working with over 65 different carriers. Now, in that, we wanted to take a look at what was working and start benchmarking out where each annuity lay. Because right now we're in a fast-moving environment and in a weird environment for annuities. We've had higher interest rates these last few years. That's been a gold rush for annuities. But we're also in a state where we have high volatility. Usually when you have that safe money returns, you're seeing the market stabilize. But right now, we're having some record high volatility, which makes annuities really look better than they ever have. You have safe returns you can't lose money on, and you have high guaranteed rates. And the more and more volatile the market is, the more likely people are to put in products like this. Now, with that being said, in a lot of these marketing efforts, I'm seeing people clicking on how to position annuities. When do annuities work for clients? And some basic questions being answered of how cap and par rates work. So before we dive into the results of the stress test, I want to go through the current market of annuities and where they fit. So I want to be honest and start off with the problems they can create. Liquidity issues. This is going to lock up money for a certain amount of time with surrender charges. Now you're going to have free withdrawals available, but you need to make sure that fits the client's needs. Some of these may underperform. In that context of being in a high volatility environment, we're seeing a lot more carriers move towards volatility controlled indexes. And a lot of those have underperformed, and they're black boxes that are hard to understand what's going on to them and can change in a moment's notice. And so we've seen a lot of those underperform the market. Now, some may have fees. If we're talking variable annuities, I've looked at replacing one that was up to 5%. But even in the current FIA market, we're having fees of up to 1% that could create some drag on the policy. And then also means you can have a loss if there's a 0 year. Not a loss in the market, but a loss from fee. Sold and not solved. If you're a hammer, everything's a nail. And there is the push to use annuities to solve every situation, but they have their situations they fit well in and work as incredible solutions to. They will not work for everything. And the wrong product being chosen. We talked about this with underperformance as well, that there are annuities out there with some very clever, great features that when put to the test, they just will not perform. And so we often see these being positioned as the catch-all solve, when in actuality, they're not going to hold up to the promises that you're making on those illustrations. So what are we looking to solve with annuities? Income for life you can't outlive, competitive fixed returns, and degree index linked returns, and safe growth without risk. I do not want to say these are completely without risk. There is renewal rate risk that if you're promised a 15% cap in year one, it drops a 2% cap in year two, and you can't make the money we're looking to make out of these. Now, with that being said, we're going to be honest with you. We want to work with companies that publish their renewal rates, and so we can understand how they react in market conditions or guarantee those renewal rates to try and remove that risk as much as possible. Long-term care coverage is another popular use for annuities, but I want to give a caveat to that. That is a larger discussion for us, especially doing the work that we do here. There are life insurance policies with long-term care riders, there's hybrid long-term care plans, and there's annuities built for long-term care. Each has its own situation where they do best for their clients, and that's something we want to explore more with you. And guaranteed legacy planning. I've been seeing this pushed a lot. I think it's more of a cherry on top of a sundae. You don't buy the sundae for the cherry, but it's nice to have. That this works well if you can't qualify for life insurance, or if you think you might need that money if you live to a certain age. But if you don't, you want to be able to pass a little bit more money on to your children. It could fit in those situations, but I do not think it is worth being the focal point of your sale. And so when clients are looking for annuities, they might not know they want an annuity because that it's gotten a bad rap in the past. But they'd be looking for things like income, de-risking their portfolio, competitive safe returns, long-term care plan, and a legacy plan. Now, when we look at those competitive safe returns, we're looking at returns in excess of the bond market that's been returning 1 to 3% and has no chance of going down, and even higher than the CD market, where you're seeing about 4 to 5% returns, whereas the MYGA rates now are sitting around 5.5%, depending on your time frame. So let's explore where annuities can do really well, and that's going to be in income. We're looking at here 2000 to 2024 in returns and flipped. So on the green side, it's in reverse, and the red side, it's moving forward. And let's say you put $1 million in that account and you're pulling out 5% of $50,000. You can see it at 73, the gap here, and you can see by the end of this time period that there's a $2.5 million difference, because in situation Mr. Red, we have 3 down years hitting right in the beginning. Now, this is assuming that you're pulling out 5% of that account value, and you're having a $2.5 million difference. And in Mr. Green, you can keep running with this. But for a lot of retirees, that's not a risk they want to be taking, because we cannot predict the future of the market. And so what if in these situations, you never lost money? And what if you, instead of pulling out 5%, you could pull out 7.5% up to 8.5%, even higher if you're letting it roll up? You could put 2/3 of this into an annuity, pull out that $50,000 in income if that's only what you need, and you could put the other third into an assets under management account that would experience these kinds of gains, and that could be your variable spending account you could use on vacations, emergencies, paying for a wedding, whatever you have there. And so we're looking at here a more flexible income stream in using an annuity than just having this assets under management approach. And so when I say you can't lose money, one of the most clicked on links I've sent out, probably the highest in the emails I've been sending, is how do cap and par rates work? You think this is something we've been talking about since, was it the 90s, that we would have a good understanding of how this works, but we all need a refresher. So let's look at this being in the market. We took a 2-year section out from that 2000 to 2023 sequence, and this is how it would have performed in the S&P 500. You would have experienced the full loss of 19.5%. You would have experienced the full gain. And while that is an average return of 3.75%, you're only experiencing an average return of 1.1. Now, if you have a cap, we're going to have that 0% floor. You never lost money. And with that 26.89% return, you're going to be capped at 10.5% of that. So instead of that 3.75 average, you're now experiencing about a 5% average, 5.25. Now, participation rate, you're going to be experiencing 60% of this upside. You're going to have the same floor, and in this case, average return of about 8%, and you're going to experience 16.1% of that 26% here. Now, you can probably see how participation rate can be good in some situations where a cap can be favorable in others. If we have a market that's returning 12%, it'd be much better to be in the cap. In excess of 20%, 50% cap, or sorry, 50% par looks pretty good. And so it's all about what your philosophy and outlook on the market is at that point. But if we're looking at a product that can have this sort of performance, what we're looking at, take away the income, because income, when we look at that, it's hard to say who's going to be the best, because it depends on how long they're letting it roll up, at what age they're taking the income, what state they're in, that different products will work for different situations. But if we're looking for, I need a carryover period, I'm approaching retirement, and I can't afford to lose money, this is where these things can shine for accumulation purposes as well. And this goes back to one Warren Buffett saying, it's insane to risk what you have for something you don't need. If you have $1 million sitting in the bank today and you're going to retire in 5-10 years, why would you put that at risk? Why would you risk the sequence of returns that could put you in a situation where you can't outlive those funds? Or sorry, where you can't outlive those funds. Why wouldn't you put yourself in a situation where you can't? And this also fits Nicholas Crown's bulletproof portfolio. You've probably seen him on Instagram doing old money versus new money. And that's to build wealth in ETFs, buffer with bond-based ETFs, and then de-risk by taking out chunks of your portfolio and putting into FIAs. And what this works well with as well is for those people working with assets under management to do an AUM protection plan, where you can say, instead of letting this dwindle over time to nothing, I can pull out a section, I can make sure it's safe, I can even get a trail on that looks similar to a management fee. That person can get income they can't outlive, and I can still have this pool of variable funds that I'm managing and making money off of that they can touch at any time for emergency without putting their financial plan at risk. So actually, before I dive into this, we're only going to be looking at the accumulation designs today, because like I said, for income, it's going to vary from situation to situation. And you can contact us and give us the profile of your client, and we will find you what the best guaranteed income will be. Now, one of the questions we've also had, we talked about volatility control, is bonuses. Bonuses have been extremely high in recent history. And there are strategies where bonuses are great, where you're using them to reallocate funds and using the bonus to pay for that, or you're using the bonus to get somebody out of an underperforming annuity that has a surrender charge. And bonus is probably going to be the only thing you can use, depending on state. But we've also been seeing people use them as accumulation plays. And one of the questions we've had is, does that play out? Because when you are getting those bonuses, you're typically paying a fee and you're getting a lot lower cap. So let's look at the top one in California, 18%. So in a max situation where we have an incredible bull run and you're hitting the cap all 10 years, you're only keeping 2.5% of that bonus. And now you have an average return 10%. That's incredible. I would take that any day. In the last 10 years, with these cap rates, you're going to keep a little bit more of that bonus of 4.5%. You're going to have an average return of 7%. Once again, I'd be very happy with that. And in an apocalypse situation where we have 10 years of negative returns and these are zeroed out, you'd I would be happy to get a 1% average return and keep a good chunk of my bonus. Now, let's look at the top one in the country of 27%. Same cap for this, same fee. So of course, you're going to see higher average returns. You're going to see higher preserve bonus. And I think this is a good benchmark, because if I were to say, let's only use the 18, I get complaints saying, there's higher ones out there outside of California, and this doesn't apply to everyone. So let's use this as our benchmark, these numbers. And the question might also come, what if we could get a bonus without a fee? We looked at that as well. And how does that perform against the max bonus available? Well, the top feeless bonus is going to be 10%, and you get 1 extra point in cap. In the max situation, you do better. In the last 10 years, you do slightly better, but I'd call it a wash. It's about the same. It's $1,000 difference. And in the minimum situation, you don't do as well, of course, because you're not having that same amount of buffer put in. But in a more realistic situation, you're doing about the same. But let's take the top capped policy without a bonus and see how that performs next to it. In the max situation, you're doing better. In the last 10 years, you're doing better by the tune of, what is that, $18,000? $18,000 better. Higher average return. And of course, in the minimum, you're not going to be doing well, but I would take a product that I could not lose money in any day if we were in that kind of zombie apocalypse. And if that was the situation, we'd be worried about a lot more things than just our annuity. And we'd be grateful that we had them. Do I think that's going to happen? No, but I want to put that out there as a test. So we didn't want to just do back testing when we were stress testing these, because that's how a lot of these illustrations fudge the performance of volatility controlled index or indexes designed for certain market situations we've already experienced, and saying this would have performed well in 2008. This would have performed well in the dot-com bubble. So we designed 12 different stress tests to look at these policies. Baseline Monte Carlo using 10,000 paths of long-term equity returns and volatility assumptions to create a baseline. Now, in a Monte Carlo analysis, you're going to get the 99th percentile and you're going to get the 1 percentile. And how good things can get versus how bad things can get can skew that average in either direction. So we did a bootstrapped Monte Carlo analysis where we said we're going to do the same 10,000 paths, but only use the returns from 1926 to 2023, real returns. And that gives some context to the Monte Carlo analysis. Now, past returns do not indicate future returns, but it gives some context to what's realistic in past market conditions. We did do some historical back tests of down decades and up decades to give some further context to that number. And then we simulated a constant 2% annual return, a flat decade. We also simulated with a Monte Carlo-style analysis of high volatility of 25%, the same thing with rising rate headwinds, and we did the same Monte Carlo-style analysis of an early bear market where the first year is a negative 20% return. And we did it with a sequence nightmare where it's 20% in year 1, down 10% in year 2, 0% in year 3. And then the rest randomized. The 12 tests we did here is not going to be included in this, and we could not do for all of them. And so this is something that's going to be built over time, because what it is testing rate decay on a variable basis. If we're looking at rising rate headwinds, we're looking at all those cap and par rates decreasing together. But we have published renewal rates from a lot of these companies that we can look at and see how did they react during certain market conditions. And so we were able to build a test and say, these companies decay at a faster rate than these. There's a lot more work that needs to go into that. So we're only going to be looking at 11 out of the 12 tests today and the results there. So let's look at our baseline assumptions. We're assuming $100,000 in premium. We're only looking at the S&P 500 or variants of that are readily available with performance data. We did not do any volatility controls because, as we stated before, black boxes that we cannot control. So even if we can find previous performance, we do not know if that index is going to look the same as it does today tomorrow. We also did not test the NASDAQ or the Russell or the Dow because that isn't the standard for all these annuities. But as we go forward with stress testing these and producing these results on a quarterly basis, we will begin to include them. It's just starting somewhere. So as I said, there's no cap and par decay. And if there is in any of these tests, it's all in equal percentages. And I know that's not a realistic look if you're looking at private equity versus mutual company, but we have to start the assumptions somewhere. We're not looking at any early surrender scenarios, and we're looking at a 10-year time horizon. So some of these will have a 7-year surrender charge period. Some of them will have 5-year, but we're going to maintain those same assumptions out to 10 years, just so that we can evenly weight all these. So our key findings, dollar cost averaging riders are new into this space, and they made a big difference to reduce the risk to zero. So the range that these things were performing in down years was a lot tighter, and the upside was great because of it. 2-year indexes outperformed 1 year. Now, with that being said, I do see some risk in 2-year indexes, although it's a lower chance of getting a zero. Getting a zero in a 2-year index would be more detrimental than having one major down year, having that marked as zero, and having that upswing in the second year that doesn't quite meet where the price was previously. Having that upswing in a 1 year would be beneficial in that policy. Fee-based bonuses underperformed by and large. Fee-based caps, they overperformed in bull markets. They did extremely well, but on the aggregate for an average return, they underperformed. Bonus and trigger strategies perform well in flat markets, and MYGA rates set a high benchmark for performance. So right now, with volatility as high as it is, the option prices being what they are, it was hard for the caps of many companies to allow for enough upside for you to break through the MYGA rate. So that's something to consider when you're looking at these policies. And rate lock, we did not test this, but one of the top performing annuities had one, and you can see the benefit if you were actively managing this policy. So let's dive into the MYGA rates. You should be getting these from me every Monday. If you aren't, let's talk. Let's make sure you're on the list, and if not, let's get you back on, or let's get it out of your spam folder. So this is the current MYGA market, and you can see that the best prices currently are going to be in the 5 to 7 year range. That's where you're going to see the most return. Now, even though that's where you're seeing the best return, we are going to look at a 10-year for the benchmarking for this, because a 5-year MYGA lives in a separate place than a 7 to 10 year FIA. And when we're looking at something to compare FIAs to as a benchmark, we're going to use one with liquidity. Now, that does not mean I'm suggesting you use a 10-year MYGA. I think if you're not getting as much return as a 5 to 7 year and you're locking up that money for 10 years, I don't see the benefit in it. However, that's what we're using for our benchmark here, because we're looking at a 10-year time horizon. And so we're looking at policies that have liquidity in them. Like, we wouldn't look at this Anico policy here that is 0% free withdrawals. And we're also not looking at revolving surrender charges, where every 10 years you're getting put back into a surrender charge period after a 30-day waiting period. So we're going to look at this Lincoln Financial rate to come up with our benchmark, because that is the one that would perform most similarly to an FIA. And that gives us a benchmark of $167,000. That's what these FIAs need to outperform in the baseline Monte Carlo for us to say, let's dive deeper into these. And who are our winners? We had two major winners in terms of carriers, National Life Group and Allianz. And below I've put there the products and the index strategies that performed well. So if we're looking at National Life that performed extremely well, the Zenith series here is that's going to be your non-bonus product. That's going to be the product that you put somebody in who is starting an annuity for the first time or coming out of an annuity that no longer has any surrender charge. The growth driver is going to be their bonus. And this was the only bonus that fit into the top 5. It was pretty close to the Zenith on the average, did not perform as well in bull market situations, but it was pretty close. Now, if we looked at a 11, 12, 13-year time horizon, it fell further behind. But at that point, I'm not sure if you would stay in the annuity. You would leave for a different one. So it's a great solution if you need that bonus to get somebody out of a underperforming policy with the surrender charge, because it's going to perform pretty close to the Zenith. The other one was the Allianz Accumulation Advantage 7. Now, pay attention to the 7 here, because the 7 was priced much better than the 10-year or the 5-year. And they have a very interesting strategy for their index that I also want to highlight so that you know what you're getting into. The one that performed well was a 2-year S&P futures index. Now, the S&P future does not match exactly the S&P 500, but you can go onto their website and you can overlay both their returns. They, on average, are only separated by 0.2%. So it's a pretty good proxy for the S&P 500. And because of that, you're able to get a higher participation rate than you would on the S&P 500 alone. The top that we've seen for the S&P 500 is about 55%. Here in year 1 of this 2-year strategy, you're getting 60%, and in year 2, you're getting 75%. Now, this was our top performing one. Previously, it was 75 to 90 on the participation rates, but they dropped it recently to 60, 75. Now, that doesn't mean their current book of business is down here. It's still at that same rate. Allianz has a great history of renewal rate integrity, and so does National Life. This is just their new money rate. So here's what we're looking at for the best, and I want to highlight some honorable mentions that did extremely well. I just don't think it has as much benefit. Actually, before I do, I forgot to mention this plus DCA. National Life Group is the only carrier I'm aware of that has a dollar cost averaging rider. You put the money in day 1, and it sits in a fixed account earning, I believe right now it's 3.4%. And that money will be deployed into 12 different tranches across the year from that fixed account. That significantly lowers your chance of a 0 year. Now, if we're looking at blending a 1 and 2 year strategy, ran the numbers on that, and we're looking at a less than 8% chance of a 0 year. I cannot guarantee that. I want to make that clear. That is not a guarantee. That's just looking at the chances. If normally 78% chance of an up year, and how that decreases with dollar cost averaging and how that decreases with the 2-year versus a 1-year strategy. And then if you blend it with a 1 year so that you're not having that 2-year dip. So they're the only carrier out there I've seen this with, and it showed that they were much more competitive than other carriers with similar cap rates. With that being said, these are the honorable mentions. Lincoln OptiBlend 7. It did not perform nearly as well as these two. It had a much lower cap. It did have a good participation rate, but the 7, unlike their 10 and 5, has had 98% renewal rate integrity. 98% of their policies that have gone to maturity have stayed at the same cap and par rate that they were initiated at. an incredible metric that is not true for the 10 or the 5. And so it's worth highlighting. Mass Mutual has a American Legend 7 that has a guaranteed cap. So it removes the renewal rate risk altogether. Now, the argument would be if you're with a carrier like National Life who publishes their renewal rates and you can see that they have good rate integrity, would you want to be in a 10.5% cap that has good integrity or a 7% guaranteed cap? That's going to be up to you and the client and your outlook on the market. New York Life actually came out with a similar product that has a 5 and 7 year surrender charge, and the caps are the same on each. And their guaranteed caps are on all their strategies. They have S&P and a Russell guaranteed cap, and they also have guaranteed participation rates. And finally, Reliance Standard. Reliance Standard looked very similar to National Life Group. They publish their renewal rates. They have great rate integrity. They were a 0.25% behind on the cap, but the difference was larger than that 0.25% because of the dollar cost averaging in the National Life policies. So if for whatever reason you don't want to work with National Life, but you want something that's going to perform pretty darn close to it, Reliance Standard, it's going to be your answer. So before I say these are the carriers you want to go with, I want to highlight something Tracy Lounsbury says. And we're partnering with Tracy on his Annuity Giants to get you guys annuity training, and that should be coming out in the next week or two, and getting you a discount there as well. So there was a carrier not listed here that outperformed all these policies, and it's private equity owned. And when we were checking all the numbers last week before coming out with this this webinar, they had an 8% cap drop, and they do not publish their renewal rates. So it is hard for me to put them even in the honorable mention at that point. And so that's why I want to highlight what Tracy Lounsbury says about how to spot a bad annuity. And he highlights a few things here: lower rates than you find elsewhere, specific carriers that have had poor rate integrity, ownership structures that aren't trustworthy, have had financial issues in the past, low financial ratings, or even fine financial ratings but low liquidity ratings that could get them into trouble as well. Excessive fees, excessive surrender charges, and performance-based income. Stick with guarantees. Those performance-based, just like the volatility control can look better in an illustration, so can the performance-based income. So all this takes a lot of background information that we're here to help provide to you and be honest with you on these policies. My goal is to be in this for another several decades. I do not have any incentive to give you a bad product that's not going to pay out. My goal is to be giving you good products that make your clients happy, that make them come back to you. So, ending this, I'm putting my contact information on the screen. If you want to get set up with the annuity training early, please give me a call. I'll get you early access to that. And we're also looking to partner with a lead generation source that we're getting that set up as well. But if you want to get early access to that as well, give me a call and we'll talk with our lead gen provider and see if we can get you an early seat. So thank you all for coming. Please also feel free to give me a call if you have any questions about this. And if you want to see any of the data from the stress test on these top annuities, reach out as well, and I'm happy to send over what I have.